Welcome to PIMCO Pod. In this episode, we discuss the Trump administration's plan to scrutinize foreign trading practices and potentially impose reciprocal tariffs to tackle the U.S. trade deficit. Stay tuned after the conclusion of the podcast for additional important information. Reciprocal Tariffs: The Trump Administration's New Trade Strategy by Tiffany Wilding. The Trump administration's 13th February executive order expands on the ideas and policies introduced in prior announcements on U.S. trade policy, directing agencies to investigate foreign trading practices that contribute to the nation's large and persistent trade deficit. The order aims to impose reciprocal tariffs that match trade barriers faced by U.S. exports while broadening the definition of non-tariff barriers, including value-added taxes, VATs, extraterritorial taxes, currency policies, foreign government subsidies, and regulations that disadvantage U.S. trade. We estimate this executive order could lead to substantial increases in the average effective tariff rate on imports, potentially ranging from 1 to 10 percentage points or more, depending on how the administration assesses these non-tariff barriers. Solely seeking reciprocity just in outright tariff rates, whether at a product or country level, would raise the average effective tariff rate on U.S. imports by an estimated 1 to 2 percentage points. This would be only somewhat larger than the approximately 1.2 percentage points increase from tariff policy in Trump's first administration, and all else equal, it could add perhaps 10 to 20 basis points to U.S. inflation. However, depending on how the administration defines non-tariff barriers, these policies could substantially raise U.S. imports tariffs by 10 percentage points or more, especially on countries with the largest trade deficits with the U.S. It's also worth noting that further policies are likely still to come, such as steel and aluminum tariffs announced last week, slated to take effect in March. Another key date is the 1st of April, when federal agencies are due to deliver their reports, and we could see further action on reciprocal tariffs. Addressing trade deficits: a new strategy. While markets appear to focus on the relative tariff rates between the U.S. and other countries, we think the aim of the Trump administration's strategy is potentially larger in scale and scope than just matching our trading partners' tariff rates. As we've discussed recently, see the 17th of December 2024 macro signposts, "Will you see bold policy choices in the U.S.?" The administration sees the U.S. trade deficit as symptomatic of decades of unfair policies of our trading partners, which have disadvantaged the U.S. In the administration's view, foreign currency manipulation and implicit or explicit foreign government manufacturing subsidies have reduced U.S. manufacturing as a percentage of GDP, driven up foreign excess savings, and increased demand for U.S. treasuries and other U.S. assets that serve as a stable store of value. While administration officials have hinted at a willingness to negotiate, suggesting that few or no tariff changes could occur if favorable deals are reached, the overarching message remains clear. The U.S. intends to take a more aggressive stance against trading partners perceived as unfairly disadvantaging American goods. Some countries may simply choose to reduce their tariff rates in response to U.S. reciprocal tariffs. Reducing the tariff rates on U.S. exports in key industries such as autos, energy, and food seems very plausible. However, it's yet to be seen whether Trump can negotiate broader-based structural reforms or push for greater domestic fiscal stimulus among serial trade surplus countries to rebalance their economies toward more consumption and defense spending, for example. Targeting major trade partners. We think the aim of Trump's fair and reciprocal plan is to increase scrutiny on countries that run serial trade surpluses, including China, the European Union, South Korea, Japan, Mexico, and Canada. As scholar Michael Pettis pointed out in his 28 of June 2024 article, Trade in the Manufacturing Share, large surplus countries are also those with the largest shares of manufacturing output as a percentage of GDP. Manufacturing has migrated to these countries because they are the ones with the largest explicit or implicit manufacturing subsidies, which tend to distort competitive market dynamics and in turn have contributed to the U.S.'s lower share of manufacturing as a percentage of total output. During Trump's first administration, the U.S. Trade Representative investigated China for unfair trade practices, including intellectual property theft, forced transfer, and other implicit manufacturing subsidies. The second Trump administration has already raised tariffs on Chinese products by 10 percentage points, bringing the average effective tariff rate to roughly 20%, and could raise tariffs further. Federal agencies' investigations into trade policy will likely have broader implications for other countries accused of having elevated non-tariff barriers. Many believe Germany's labor market reforms in the 2000s have suppressed wages and labor costs, while the value of the euro, which reflects EU average economic fundamentals, gave Germany more support. Ireland's tax regime offers a well-known shelter for recording the profits of intellectual property, particularly in technology and pharmaceutical products, limiting U.S. government revenues. Japan's explicit subsidies to its auto and tech sector, along with the close business relationships facilitated by the Keiretsu system and the Bank of Japan's low-rate regime, have also drawn criticism for creating an uneven playing field for U.S. manufacturers. Concerns about Vietnam have grown as formerly Chinese supply chains have shifted there. Tariff disparities and their implications. Equalizing tariff rates across countries and products would also have implications, although on aggregate such a policy would only raise the effective tariff rate by 1 to 2 percentage points by our estimates. Countries with much higher tariffs on U.S. exports, including India and Korea, are likely to see substantial increases, although imports from these countries make up a smaller proportion of overall trade. U.S. exports to India encounter tariffs that are 7 to 10 percentage points higher than those imposed on Indian imports, while Korea's disparity is 6 to 12 percentage points. Even Mexico and Canada, with whom the U.S. at the moment has free trade agreements, impose tariffs averaging 3 to 5 percentage points on American goods, often due to differing environmental and health regulations, limiting processed food imported from the U.S. due to higher restrictions on food additives is one example. These countries have also negotiated tariff shelters for specific industries. Canada shelters its dairy industry with tariffs greater than 200% on above-quota imports, while Mexico similarly shelters its sugar market. Rules of origin requirements are also at the heart of tariffs on auto parts traded among the U.S., Canada, and Mexico. The role of value-added taxes. The Trump administration also hinted at potential inclusion of foreign VATs in reciprocal tariff calculations. Theoretically, while VATs should not change a country's relative competitiveness, see the 1990 study of Feldstein and Krugman for more explanation. An empirical study by economists at the IMF too found VATs have improved trade balances, particularly in the euro area, due to limited currency adjustment and/or price adjustment. This is likely motivating the Trump administration's choice to potentially include VATs. Navigating economic volatility. Overall, the Trump administration's aggressive trade policy aims to rectify the U.S. trade deficit through increased tariffs and scrutiny of foreign practices. Trump has signaled he is willing to negotiate. However, the structural reforms likely needed in the countries with the largest trade surpluses and manufacturing bases aren't likely to be negotiated easily. Structural changes in the U.S., including reducing government fiscal deficits, are also likely going to be difficult given slim Republican majorities along with political and legal constraints. In the absence of reforms, the Trump administration can look to force these changes by trying to engineer an effective dollar devaluation. The administration could attempt some combination of raising tariffs and trying to limit the offsetting dollar depreciation. Although without a coordinated global intervention or a material reduction in the Fed funds rate, neither of which seems likely, it's not obvious how the administration could accomplish this. All of these policies and negotiations are likely to coincide with some economic disruption and market volatility in the near term, even if we eventually see medium-term benefits of a more balanced and stable global trading system. How much volatility is tolerable is still the key question for the outlook, in our view. So far this year, the overall market reaction to Trump's trade moves has been surprisingly muted across currency, bond, and equity markets. Perhaps markets reflect a relatively sanguine outlook among investors about U.S. trade policy, or perhaps investors believe tougher policies are still likely to come. Regardless, the relatively muted response could embolden the Trump team to take more aggressive actions ahead. Thank you for listening. That was Reciprocal Tariffs, the Trump administration's new trade strategy. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need, and it is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.